Now let's talk quickly about some of the new OSPs. So when we look at the Middle East Arab Light, talking Saudi to Asia, there was a fairly big drop in terms of pricing. I always like to look at it against the seasonal, just because is it supposed to cut at this point in time? And here you can see it's typically starting to increase, but it's now back to where it was in 2011. And it's really hard for them not to cut when you look at where Dubai is, the discount Dubai is trading at, and the fact that they're bringing more barrels on. Now, understand there's some dynamics behind that. They're bringing on about 100,000 barrels additional in terms of just along with the OPEC agreement. But they're also consuming less internally as they come out of peak electricity demand season for obviously cooling, being it's in the desert. So you have a slate shift where you not only are consuming less internally, and you're also increasing production. So on both sides, you're going to have more crude that you're going to have to move. And when you look at the fact that West Africa is struggling to sell, and that's more a Nigerian comment versus Angola, because Angola is fairly stable when you look over the last 6 months. Still slow historically, but okay when you look at where we sit at this new lower norm. But then you look at North Sea pricing coming way down. You look at CPC pressure. You look at ESPO pressure. There's a lot of pricing that they're going to have to compete against. There is term here, so there you have some beholden buying. But when you look at the price discounts coming through, then you have Libya that's cut, and we should see additional cuts as we come through, and things are announced as we go into September, October, with some of this pressure as they look to, again, clear some of this product. And by doing these cuts, you also provide some uplift to refiners, because refiners are buying at a cheaper rate, at a cheaper price that can push through some additional cost savings. And again, these are some of those little things that are going to be factored in. Now, when we look at China crude imports, so here's where you can see the imports. Crude imports were at 10.53 million barrels a day in August versus 9.75 million in July. But in August, they were 11.23 million in August of 2020. So we're still, let's call it 800,000 below where we were in 2020. And we're just not really going to see too much of that shift. So at the same time, you have lower runs, but China's gasoline exports so far this month have been at 422,000 barrels a day, the highest level since May, according to Vortexa. Compares with 240,000 barrels a day in August and 100,000 in July. So again, getting that big increase. So yes, we did get an increase in crude imports, but we're also getting a big increase in product exports. Excuse me. So again, that divide is important, because if you're importing more crude and still exporting less product, well, you're importing more, but you're importing more and exporting more product, that's going to offset. So that's why we look at it. Diesel exports so far this month are at 360,000 barrels a day, also the highest since May, compares with 224,000 barrels a day in August and 160,000 barrels a day in July. So we're still very strong. So you're getting big exports on both sides. And for those that have been following us on the Econ Show, since we've launched the Econ Show, we've been highlighting that local consumption is very low. Local consumption is struggling. They're trying to do things to pick it up. And what does that mean? Dual circulation strategy, common prosperity. They're trying everything to drum up more demand. And they're doing that as well as keeping prices low, which is why we've shown that chart time and time again of PPI versus CPI. China did increase pricing for gasoline and diesel, but they had to based on where Brent is right now. But they can't raise it too much, much more. When you look at, they're trying to drum up more buying, more demand, but they have to keep inflation low. They have to keep these prices low, which is, they've released from, I shouldn't stop saying, because, I'm just trying to explain what I've seen so far. When you look at commodities, you look at aluminum, copper, coal, and now crude releasing 22 million from the SPR. You're seeing that steady movement because they're trying to manage price and bring prices down, which when you look at Saudi, they cut prices to Asia. They kept them stable for Europe and the US, because again, they're trying trying to drive some additional capacity into Asia, and the market just isn't there right now, as we can see from floating storage and now from the export of product. So when we look at this a little bit differently, again, talking about the commodity, when we put it on our favorite seasonal chart, you can see the increase. We did get that increase in 2021, but we're still well off of where we were in 2020. And it's just, we're starting to see some of this level off, which a level off realistically going back through time, looking at 2020, 2019, on the average, you look at just every year, you kind of go flat. And that's because you're shoulder season. Some things turning on, some things turning off. As we talked about in segment 1 of the Econ Show, we have to look again at the Three Gorges Dam. There's a lot of water piling up. The typhoon, depending on which way it shifts, that's going to impact things as well. But now when we look at some of the quotas, so the NDRC approved 2 million tons to Shanghai imports, quota for Q4, 16 million tons for 2022 so far. We expect 15 million tons of fresh quotas to be awarded for Q4 2021, including allowances for Rongsheng Phase 2, which is a new facility coming on. The teapot side, again, they have been big buyers of ESPO, Johan, and Oman. That's something similar, especially when you look at Mars losses. That's Pemex, that's US. So you're starting to see that competition. But remember, ESPO flow is at a 17-month high, and we'll talk about more about that in general. And then when you look at the North Sea, it's at a near all-time high in terms of the amount available. So those are going to be things that are going to get, or even though we have a little bit more buying from China, you will get the volume backdrop, which will help insulate some of that in terms of pricing. Now, when we look at U.S. exports, you had an increase of 268,000 barrels a day in gasoline. You had a small increase of 58,000 barrels a day in distillate. What we were saying, we were expecting a little bit of a bounce in gasoline, essentially flattish in disti, as there's a lot of competition with that flow coming from Europe, from Asia and the Middle East into Europe. But propane, again, 330,000 barrels a day. Yeah, baby. 804,000 above the 5-year average. Again, it's going to be very strong. We see a lot of that demand in general. And then when you look at crude oil exports, we had that drop that we were talking about. A bit higher than what we were expecting, but again, you had the hurricane impact. And even though exports weren't impacted as much, you still can't really, you don't want to take a ship through the storm, so you have to wait. That can shift in terms of when you can continue on your path to get to where you need to go. So again, that was a drop of almost 700,000 barrels, bringing us to about 2.342 million. Now, when we look at some of the shifts in general, it's right in line. We expect that 2.6, 2.8, probably closer now, just with some of the makeups at 2.8 million barrels a day of oil exports. That's going to continue, but we do have that pricing pressure. WTI is still rich versus other crudes, especially when we look at Dubai. And then that comes back to where's Dubai, where's Oman, Kuwait, UAE, Iraq, Saudi Arabia, as we do have some of those exports increasing based on the OPEC agreement and less local burn, putting more crude on the water. So that's when we look at WTI versus Dubai. You see that we're still hanging at about a $3.75 discount of Dubai versus WTI. That's really hard to overcome when you're considering what are you going to purchase. Well, you're going to buy Dubai versus WTI first. So again, this is where we keep talking about these pressure points as we look at what is happening between the two and where those discounts are going to be factored. Then when we look at Brent Dubai, something very similar. Now, Brent should start to come down a bit, but it depends on the basket, because when you look at Brent versus Fortes versus Johan versus just Norway in general, you're getting some of that volume increase, but right now Dubai continues to maintain some of that discount, again supporting Dubai purchases versus Brent purchases. So when we look at gasoline, as we were expecting, a bounce back to the 5-year average. Instead, we went just above the cloud here. We expect it to fall back into this 5-year average. Nothing too crazy. It's just going to be a lot of noise. Now, when you look at what has happened for gasoline storage, what has happened in the U.S., it's going to incentivize keeping more in the U.S. versus exports. But something that we've been talking about, naphtha or blending has been included in this gasoline number, and there's still demand for that. So that's going to provide some of that support, which is why we think it's going to go back to about the 5-year average, not through it, because when you look at the numbers, you're like, why would you export gasoline? The U.S. is a great market right now. And it's really, you're not. You're exporting something a bit different, but it's just semantics as to how it is labeled. So here's where we look at disti, as we were saying, just kind of sideways. There's not too much to say one way or the other. We think it's still going to just continue to go sideways again, just because there's so much new product coming to the Atlantic Basin, providing that headwind. Here's that drop in oil. Again, more of that sideways, kind of that just going back and forth. We do expect an increase, something closer to that within that range, and then living within that over the next few weeks. And here you can see a little bit of a pullback to 2.9 as we progress into next week. This will come back into what we think is the high end of our estimate of that 2.8 million barrels a day of export. And then when we look at propane, it's just going to stay strong. There's nothing else to say. Even though you had an increase in exports because you had chemical facilities down, so you're going to export versus keep it in local. Now we think that you'll continue to see this bid out there. You'll see it drop, but again, it'll be at a seasonally adjusted all-time high, continuing to set a 2021 a new record for year-to-date exports. Now, when we look at India total petroleum product consumption, you can see that we did get a drop. It's still above where we were in 2020, but still well below 2019 when you look at how it's trending. Gasoline demand still elevated, still higher, but diesel is still very disappointing. And that's when we turn again back to what we keep discussing of diesel versus gasoline, economy versus consumer. The underlying economy, and this is more than COVID, and we talked about this, I mentioned this several times in the Econ Show. This is more than COVID. There is an economic problem, an economic slowdown, and you just have to look at diesel prices. Diesel consumption is really telling you, and this is looking local, because in the U.S., things have been very strong on the back of shipping. But when you look, we don't use diesel in the same way that some of these other third world emerging markets do when you're looking at manufacturing. So the fact that diesel still remains so low, and diesel is almost twice the amount that gasoline is. So even though gasoline's elevated, diesel being down has a bigger bite into total demand versus gasolines. And and again, it's a better bellwether for that Indian economy, which continues to struggle. And we're seeing that play out time and time again in a lot of these other markets, i.e. China, India, some of the important growth metrics for that to hit that global GDP number that we keep hearing about, which, as we've been saying, is over and the estimates are too high and should come down. Now, when we look at Genscape in Europe, you can see that there was a spike as we expected there to be a spike. We think it's going to be a fairly steady increase. Again, this was a decent move. We think it's going to continue to rise, but it'll be at a more measured pace. So the pace of increases is going to abate a bit, but still move in the direction closer to that 7-year average. And again, it's that timing delay of where are the offshore storage, where is onshore storage, how much of this new flow out of the North Sea is going to get sold internally versus going abroad. That's going to address and adjust what is happening in some of these tank stocks. And start on some of these onshore tank storage. So now when we look to the loading schedule, you can see that we're at about 10.9 million for October. September, we had some slippage in Angola with one big deferral that of about 1 million barrels. We'll talk about that in a minute. But then when you look at Norway, so Norway at 1.679 million. You look at the North Sea, 851.6 thousand barrels a day. We're seeing this big increase in terms of volume. Now, the one to watch is Libya. So Libya right now for September is at 1.2 million, 1.198 million. There's about 800,000 barrels of that is at risk. So far, it's 3 locations. It's been protests but then as the protests have abated, they've been able to come in and load. It's going to throw off timing. So we could see some of that slippage into October, or we could see an all stop. Again, it's all going to be internal dynamics, which is also providing that bid behind Urals, because that is the natural replacement for some of the things that we've seen in general. So when we look at some of the adjustments so far, so just to give some quotes, so Angola revised loadings of its Plutonio, Dalio, and Saturno for July through September. Spain's imports for Nigerian crudes in July rose, but it's risen for Nigeria's risen for some areas. So Angola's rescheduled 1 million barrel cargo from August into September. Shell bid Urals at the highest price in 7 months. What is that? What does that equate to? Right now, Shell bid about $1.05, so $1.05 discount to dated Brent. That is off of the most recent, which is $1.25 off of dated Brent. So again, moving in the right direction. Any bid 80,000 at $1.15. So you're still seeing, again, some of that movement up, which is a net positive. But you're seeing that the bids are coming from, when you look at China bought 0 Urals in August. A lot of this is coming from the U.S. The U.S. is driving this, as well as the concern over Libya, which is putting a nice bid behind some of these Urals. And it's going to be a matter of how much does that continue, because CPC is not seeing some of that similar view, where we did get a bid withdrawn for $1.70 discounted dated Brent of CPC. Could be a little bit of waiting, trying to wait out some of these movements. There was 85,000 tons of CPC blend offered at $1.95 dated Brent. Again, it's just going to be a matter of when does it cross. That's below the $1.75 that it previously was. So you can see how it's a game. It's, where's the offer, where's the bid, and then if you could say, okay, well, why wouldn't the offer not go through for one, even though there was a bid at a higher price? But it's, where was the bid? What volume was it for? What type? What port was it going to? Was there ship available? So that's where you can get into some of the conundrum. Now, speaking of ESPO, so 32 cargoes of ESPO crude totaling 3.2 million tons are scheduled to be shipped in October, and from the preliminary schedule, and that equates to 757,000 barrels a day, which is the highest since May of 2020, and compares with 718,000 barrels a day in September. So you're still seeing that increase in general, which is putting some of that discount, but also opening up some more purchases into the U.S. and other regions. Now, just shifting over a bit to the Middle East. So Iraq boosted oil exports by 4% in August to a 5-month high, with shipments from the southern port of Basra jumping, along with an increase of central government sales. Exports rose to 3.389 million barrels a day last month, which was up 132,000 barrels from a revised 3.26 million in July. So sales to China, Iraq's largest customer, retreated to a 6-month from the 6-month high in July, settling at 901,000 barrels a day in August, which could increase, but it's going to most likely be flattish as we go forward. But sales to the U.S. of Iraqi crude surged in August to 157,000 barrels a day from 32. That should continue, which is going to be a matter of where is the U.S. going to get some of the cheapest barrels available. So crude and condensate shipments from the UAE slipped slightly in August to a 3-month low, even as exports increased to a 13-month high in China. Now, remember, UAE is increasing to China. Saudi Arabia is cutting prices to China, Asia. Again, some of that bidding that we're going to continue to see, but the slowdown in demand we did get some of that, some benefit with some of the discount between Brent and WTI loosening up a touch in August. That has now moved back. So again, you're still going to see some of that movement. And then when we look at North Sea benchmark, crude prices dropped sharply in recent days, following a big increase in loadings planned for October. The differential for Fortes, the grade which is usually used for the global benchmark of dated Brent, dropped to a discount of 6 cents a barrel to that marker on Tuesday, again, moving that down in general. Just a week ago, it was still at a premium of about 80 cents. So you were at 80-cent premium to now a discount of 6 cents. So you get an idea of how big that drop was and what does that mean for demand, forward buying, and what are these movements in general. The weakness in North Sea crude grades comes as loadings of the region's 13 main grades surged to 2.1 million barrels a day in October, the most in more than 4 years. As we continue to see that move through, again, more volume coming on. And that's coming, now remember, that is marrying with the OPEC increase, the fact that OPEC is increasing 400,000 barrels a day along the deal line, OPEC plus deal, but they also have less local consumption. So again, just more crude hitting the water as into a fairly soft physical market that still remains. So then when we look at what is happening in Fujairah, so when we look at total September, Fujairah reported 18.462 million barrels in storage. Total stocks were up 780,000 barrels. That's up 4.4%. Light distillate fell 7,000 barrels, so just fairly small to 5.755 million. Gasoline demand was seen rising in Asia, as we did see some of that pull through in general. But now we're seeing a little bit more storage as the Middle East, I think it's Kuwait, is turning on one of their main gasoline processes, which should increase the amount available within the Middle East, and again, slate more for export. Middle distillate rose 309,000 barrels. Up to 3.984 million. That's a reversal of last week's loss, which is what we were talking about. There is that ultra low sulfur diesel support in Asia, where the market again remains tight, and it's going to be with South Asian buyers, with Pakistan, Bangladesh, as we talked about earlier, looking to purchase some of this fuel oil. Now, how much of that is going to be deemed as heavy resid versus middle distillate? It's just going to be where is the sulfur level and where is that heavy fuel oil versus other. So then when we look at some of the shifts in general on the other side, so heavy resid rose 478,000 barrels to 8.723, which is a reversal of last week's draw of 442,000, which we were saying. That's going to, again, ebb and flow. In general, we still see a fairly steady increase in storage that's going to show up in Fujairah, just given some of the pressure points within the global market. So when we look at crude oil on the water, we're right at the five-year average, just that steady increase. But we have to understand, what is that increase? What is driving crude oil on the water? So when we look at transit, we had a nice little spike to just below the 5-year average. That should see some additional flow, as we do have some purchases from West Africa, some additional purchases coming into the U.S. So again, that's going to keep some of that bid or some of those additional cargoes in motion, filing it under here. But then when we look at crude oil floating storage, you can hear we still are still rising, still well above the 5-year average. When you look up against 2020, typically at this point is when we hit the low, and then we start to see storage come back up. Again, in a very weak spot. This is an issue based on timing, as well as just not enough demand onshore to try to move some of this through. Again, leaving some of this crude sitting there, and we're coming up on the highs of 2021. And this should have been worked down already. And that's when people will talk about onshore, but ignore the offshore side. And I think you have to look at both of them in tandem to understand how bullish is one versus the other. Because if they're both bullish, then game on. But if one is bullish, the other's bearish, how much does that negate? How much does that balance out? Where is the barrels coming from to offset where maybe some of this oil floating storage comes down, but then it's replaced with oil in transit? And again, it's just going to be semantics as to how much oil and floating storage falls because of the typhoon and then comes back. So we could get a little bit blip lower. Now, when we look at what happened in Europe, this is real time because it was released today, so we can at least report about it today as it comes out. So here's where we're finally starting to see some of these tankers show up. We're starting to see some of these imports that we've been alluding to coming into and actually hitting the market. Gas oil was up 186, gasoline was up 168 tons. So again, 1,000 tons. So you're getting some of those increases. It's It's still going to be bullish in terms of where positioning is, but you're going to see that steady rebuild, especially on the gas oil side, closer to that 15-year average, or I should say that 13-year average, as we kind of progress fairly slowly. And the comps get easier. Like, look at where the comps are as we go through the end of October. So it's not going to be a rush up. There's going to be a matter of managing some of this flow, as gasoline also saw a fairly steady increase. Here's where we were expecting to see a spike. We didn't expect it to get to the 5-year average, so it's just below. But remember, the comps get easier. So when you look at where this is, there's typically that normal drop down of gasoline flow. Again, it's already at this point. We should see gasoline storage kind of level off a bit, possibly a small increase. It's just right now the flows to America have increased. So when you look at what is coming across, when you look at fuel flows, so we already have about half of the 3.2 million tons observed in August already, with more cargo set to emerge already en route. So or spoken for. So we will see some of this be managed, because you're going to get the export from Europe into Pad 1. And then when we look at fuel oil, we expect to see kind of the steady move down as there's recracking. There's some of this bullishness that is going to support some of this being used within the refiner itself. Now, we did get a fairly big increase in Singapore by about 2 million barrels, but it was really only driven by resid. So you can see, as we were saying, it was going to kind of do this chevron pattern sideways. Instead, we got a fairly steady decline. Now we're getting a little bit of an increase. We still think that as a total aggregate, it's going to be a fairly sideways move. This is when we talk about Europe and we talked about the arbitrage, it was wide open. It made perfect sense to either export directly from the coast of the country or from storage. And here is where it's starting to show up. Now, this is the timing delay as well. This will be backstopped with additional flow from Asia. So when we talked about China earlier of increasing the amount of diesel exports, some of that is going to head into the market. Some of that is going to show up in Singapore. So you will see this offset, and we'll move closer to the 5-year average, to the 15-year average. It's just going to be a timing delay as to when, because a lot of this crude this drop is heading into the Atlantic Basin. So then when we turn to light distillate, as we've been saying, there's still that demand problem where, and then we look at China, as we talked about, increasing exports. This is going to keep this fairly elevated and really moving sideways as we go through the remainder of the month. The time spread November, December got a little bit stronger, came back to the highs, starting to come off a bit as crude is faded as we've been filming this. There's still support down here at about 60. It's just going to be a matter of that timing and where those bids are, because spreads have been the soup du jour for people who want to get a bit more aggressive with some of their positioning. Then when you look at WTI Brent December versus December, here you can see, as we were saying before, we thought it was going to move sideways. There's enough bearishness moving in to offset some of the bullishness, but not completely. And then when you look at where it is versus Dubai, you kind of get an idea of where it's sitting right now. So here's where it's going to kind of waffle back between that $4 and $5. So even though we did see that discount coming through on crude, we are seeing a renewed softness in Singapore. Again, it's just Asian demand just isn't there. It remains struggling on the other side. Saudi and the Middle East is trying to offset that a bit with some of those discounts coming through. But you can see that net, it's still a negative. And then when you look at hydrocracking, it's still at that, essentially just gone sideways the whole year with very little movement to the upside. Urals margin coming down a bit, as you saw, again, pricing get a bit more expensive. But when you look at the net margin on a net level, you're still making money. So we should still see those Urals being consumed. And when you turn to the Med, you're getting a bit more pressure because demand isn't as good in the region, and now you're losing Libyan barrels. So now you're going to have more pressure and bids on Urals, which again is going to put some pressure. On a net level, you're just barely positive, but we expect to see a bit more pressure coming through. China supertanker crude imports, again, falling. We just expect it to move along the 5-year average. Again, weighed down by the amount of where our import quotas, as we talked about, some of them coming through. But then as we shift over into what is happening with the typhoon, what is happening with offshore storage, and how is that going to move through the system. We did get some increase in run rates in the Shandong or the teapot side, 71.3%. We don't see it going much higher, but we also don't see it going much lower. The state-owned guys continue to be fairly muted. We think that you'll get a little bit more of an increase as we progress through the remainder of the month. And again, that's going to cap out teapots as we get some of that state-owned coming back. But given the slowdown in demand internally and the increase in exports into a fairly tough export market, you might see a bit of a muted move. Now, when we look at Asian floating storage, continuing to go higher, again, reversing trend and moving back up to the highs. And this is going to put additional pressure when we look at where is onshore storage, where is some of this flow, and at what price is some of this purchased. Again, the pressures that we continue to see in the physical market. Then when we turn to North Sea, again, with this new renewed push of near 4-year high production, we expect to see this continue to shift higher. It won't move in a straight line, but again, we still expect this now to shift above the 5-year average as we see some of this additional cargoes getting moved. And then the question is going to be, is it going to be consumed locally, get exported? That will be one to watch. As West Africa continues to shift higher, this will remain elevated, just given, even though we have seen some Nigerian crude start to move, still a lot of pressure there, which is going to keep this very elevated. Middle East had a nice drop, but based on what we've seen so far with renewed cargoes coming on slated for sale, we do expect this to, again, when you look at the seasonal side, we typically see a seasonal pop. So we just think that right now you're going to see a very seasonal pop. It's just the seasonal movement is going to be a little bit exaggerated, and we should not getting back to 2016, but we should get back to that 2018, 2017 high, and even probably a little bit above it, based on the struggles in the physical market and the amount of crude that is now slated to be sold. All the while, Europe had a little bit of a drop, but as we've been saying, we expect kind of that sideways move of that chevron up and down. And as you look at the comps get a bit easier, which again, will just move things in line. When we look at Shandong, when you look at the teapots, again, crude oil storage still at near all-time highs. Not much changing that, as fuel oil is at the highest level since 2021. Again, a lot of that pressure is we keep hearing these comments, but then when you look at the underlying data, there's still a lot of pressure, still a lot of things to look at and to kind of keep us a bit paused on where some of the strength is. Obviously, the U.S. is in a more bullish backdrop because of the hurricanes, but you're still seeing a lot of this pressure and softness in the global market. So if you have any questions, please let us know. You can find me on Twitter, comment section, or email. Again, thanks for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.